Hey guys, it's Willie. Today I want to take a look at Honda Motor Company. Currently it's trading at about $31. Over the past year you're looking up 11.5%. That's not as much as something like Tesla. However, if we glance at the PE ratio down here of 7, almost 8, Honda is definitely cheaper than Tesla and a lot of other car companies, these big car companies like this. I think it's a cheap value play. I think it's a good one. But let's jump over to our spreadsheet and see what we can figure out by crunching some numbers and looking at some financials. Alright, so now that we're in our spreadsheet, we're looking at Honda. Let's look at the money that they're bringing in, revenue, net income, free cash flow, those sorts of things. Revenue, you're seeing 2% growth. That's kind of expected from a company like Honda. It's a really big company. They make cars and all the other engines. They make a lot of engines. I think they're the #1 manufacturer of engines in the world because they'll make like lawnmower engines, boat motors, stuff like that. Not just cars. But revenue growing at 2% because it's a big company. Net income, I found this number to be kind of surprising, growing at 8% a year. I think that this was kind of the bottom of their cycle, I guess, because of the cyclicality of the automotive industry as a whole. You see these downs, the ups, the downs, the ups, the comes back down, the ups. So I think since you're starting from the low going to the high, you're seeing that 8%. I think it would be more in line with something like this free cash flow number where you're going at 4%. Some weird negative number in free cash flow for 2014. Don't know what was going on there. But Honda usually has, and 2013 as well, even bigger negative number. But solid free cash flow, I would say, for a behemoth like Honda, growing at 4%. Shares, they're actually buying back their shares. Really glad to see that. Rewarding their shareholders. There was a little bit of a jump in between 2012 and 2013, but since then it's been flat and coming down. Thank you, Honda, for buying back your shares and rewarding us as investors with a larger share of your business. Earnings per share growing, free cash flow per share growing 8% and 4% respectively. You're not seeing a lot of impact from the shares coming down. It's more of just closer to the net income and free cash flow growth numbers as a whole. Here are the assets. If you're interested, I don't really care about them. Here's the dividends for our dividend-focused investors. Kind of jumping around all over the place. I think part of that has to do with the exchange rate, since the dividend would not be in USD. A lot of those financial numbers coming out of Honda would be in Japanese yen and then converted over, and so you have to deal with the exchange rate and all that stuff. But I think a solid dividend from Honda for sure. Then you go on to debt. Debt looking, total debt being 117, almost $118 billion. Cash of 26 billion, net debt coming to 92 billion. It has grown a good bit. I don't have much problem. I don't know what was going on with this ROIC number that Honda had going on, but low ROIC numbers, which we expect from a automotive manufacturer. So on to our metrics. This is the reason I'm interested in Honda as a company, because of the PEs in the free cash flow numbers are screaming that Honda is cheap. The debt level, 18 times the average of the past 5 years of free cash flow compared to net debt. I have a bit of an issue. However, when you look at assets and net debt, there's enough discrepancy there to say if I were to buy Honda outright, liquidate it, you could sell off the assets to pay off all the liabilities after the cash. So it's a bit concerning when it's this high a proportion of free cash flow However, I think it'll be okay. I think it'll be all right. 5-year revenue growth -1%. You don't expect explosive growth out of a company like Honda, but over the past 10 years, we've seen slow, steady growth. So I'm going to give it more of a pass there. Earnings growth 2% over the past 5 years. Free cash flow 13 going up. That's good. Shares outstanding going down. Thank you, Honda. ROIC, we expect a lower number for an automotive company. So even though we're usually looking at something above 9% over the past 5 years average, you're looking at 8.2. I think a lot of that is skewed by this 20% here. I think you're looking more in, what is this average here? Average 5%. So, I mean, we expect a low ROIC for a automotive company, especially one as large as Honda. So, yeah, ROIC is as expected. Net income and free cash flow forecasting. This is where it gets a bit interesting, where I price Honda out in 10 years. So when we look at the free cash flow growth over the past 10 years, it's been about 4%. Net income's been faster. Again, I think it's a bit skewed because you're starting from this really low point to a higher point in the cycle. But I'm going to give them credit for 3%. I'm thinking, inflation in the U.S. is, over the long term, 3%. Here recently, it's been over. I know Japan has somewhat struggled with a more deflationary environment for some time. But I'm going to give them credit for a 3% growth rate. That's kind of the minimum I would expect out of a company. PE, I'm going to give them a price to free cash flow and PE of 10. It's low, but I think I want to be conservative with Honda. It should be priced relatively cheaply because of how little growth you're getting out of it at 3%, but I think you should pay up a bit for the security of such a large automotive manufacturer and such a diversified automotive manufacturer who doesn't make cars. They make a little bit of everything else. Based on free cash flow, you're looking at, call it $55.50. Net income, you're looking at $48 in 10 years. So right now it's trading at about $31.50. We average our two prices together. You get a price target in 10 years of $52. Come over to our IRR calculator. You're in at $31.50. You get your free cash flows, some of which you'll get in dividends, others you'll get as part of it piling up on the balance sheet or as buying back shares. You're out at $51.87. You're looking at a 22% return. I think this is very, very, very interesting coming from such a large company and making such conservative growth rates. And as always, I like to come over here and assume that things get really bad and see how bad things have to get before we get a market return. -3% gives us a 13%. Whoops, let me try that again. Not -500. Why can't I use Excel when I need to? Alright, and then that gives us our 10%. So, I mean, even if Honda was losing 5% over the next 10 years and then trading at only a 10 PE, you'd still see a market return of 10%. I think Honda's really attractive right now. If I revert back to my old numbers, 3%, 10 times, you're looking at the 22%. I think Honda's really attractive, a really good value play. The debt, I would worry about the debt. I'd want to know about the debt to see if it's manageable. It was 18 times 5-year average of free cash flows. I understand with automotive companies, these factories are very expensive. The equipment is very expensive. The R&D is expensive. The design is expensive. Everything is expensive. I understand that. So, the debt, I can see a reason for it. However, I can also recognize that 18 times free cash flow is a lot of debt. Assets kind of balance it out, but that's the one thing I would worry about with Honda is that debt number. Compare it to other automakers, compare it to the industry overall, see if that's normal. That would be my recommendation for the next step of research. But as always, do your own due diligence, do your own research, plug in your own numbers. Like, comment, subscribe like the algorithm wants you to. And beyond that, I don't have much else to say, so I will end the video here, and I will let you guys look at these numbers, do your research, all that good stuff, and I will catch you guys in the next one.